Hello and welcome to InvestTrek, the channel where we help beginner investors level up their knowledge, build wealth, and finally stop Googling how to make money without leaving my couch. Today we're diving into real estate investment trusts, or REITs, pronounced REITs, but not quite the same as the sound you make when you accidentally stub your toe. What are REITs? A REIT is a company that owns, operates, or finances a portfolio of income-generating real estate assets and sells shares to investors to raise the capital to do this. Investors then purchase these shares to earn returns without directly owning the physical properties. REITs are like that fancy Airbnb rental house that you get to enjoy without having to mow the lawn, pay property taxes, or deal with creepy basement tenants. They allow you to invest in real estate without the headache of being a landlord. Forget clogged toilets, sinks, and angry tenants. REITs handle all the dirty work. REITs invest in everything from office buildings to warehouses, retail spaces, and even hospitals, so you could technically own part of the waiting room chair at your local clinic. They come in 3 flavors: equity, mortgage, and hybrid. They're like the ice cream of real estate. Some own the properties, some lend money for the properties, and some do a little bit of both. How REITs work. REITs are like the group project of real estate. Everyone throws in a little cash, and then a group of experts buys and manages the properties, while you sit back and hope someone actually does the work. They make money through rent, property sales, or interest. And, this is the cool part, distribute at least 90% of their taxable income as dividends. So, while you're on the beach sipping margaritas, your REIT is handing you checks like a personal ATM. Advantages. Diversification. REITs give you exposure to real estate without having to buy a whole neighborhood. High dividends. Thanks to that 90% distribution rule, REITs often pay big dividends. It's like having a job, but you never have to leave your couch. Liquidity. You can buy and sell them easily, unlike actual real estate where you need a whole open house situation. Professional management. REITs are run by experts, so you don't need to know how to fix a leaky faucet. Disadvantages. Interest rates. REITs can get a little shaky when interest rates rise. They're like that friend who can't handle spicy food. When interest rates rise, they start sweating and things get a little shaky. Property risks. Economic downturns or a sudden glut of shopping malls, looking at you, retail sector, can make REITs perform like a poorly thrown pizza dough. Lower capital appreciation. REITs won't make you rich overnight, unlike some growth stocks. But hey, steady growth is better than getting burned. You've got several options for investing in REITs: publicly traded, privately traded, and public non-listed. Let's discuss each of them. Publicly traded REITs, these are like your favorite reality show. Easy to get into, and you can flip the channel or sell whenever you want. Private REITs are exclusive, like that VIP section at a club, but only if you're an accredited investor and have some serious cash to throw around. The person fitting this criteria is probably not watching this video. Public non-listed REITs are somewhere between a public and private REIT. They're a little like the middle row on a plane. You might feel cramped at first, but if you hang on, you could end up in a prime spot with a great view and maybe even a snack or two along the way. Evaluating REITs. To avoid doing a clumsy belly flop into the world of REITs, consider these 4 factors when evaluating a REIT investment. Portfolio composition. What's the REIT actually invested in? Is it all the same type of property or a diversified mix? Financial health. Look at metrics like funds from operations or FFO along with its debt and occupancy rates. An FFO of around 5 to 10% annual growth per share is good, like finding extra fries in your McDonald's takeout bag. Low FFO? Not so much. Management quality. Check out the REIT's management team. If their track record is like that of a bad dating app profile, you might want to swipe left. Dividend yield. The higher the better, unless it's too good to be true. A good typical range is between 4 and 8%. Anything in the 6 to 8% yield is considered a higher yield, but higher risk, indicating that the REIT may be heavily invested in more volatile real estate sectors like malls and shopping centers. Anything above 8% carries even more risk. Potential investors should carefully analyze why the yield is so high. Tax implications of REIT investments. REITs generally don't pay corporate taxes, but guess what? Dividends are usually taxed as regular income, which might not be as fun as tax-free income, but hey, Earning something is better than nothing. Building a REIT portfolio. Start small. Don't try to buy the entire city on your first go. Diversify across different types of REITs and use them as part of your larger investment strategy. You want your portfolio to look like a balanced meal, not just a dessert platter. Deciding whether to invest in a REIT. To figure out if you should invest, focus on the top 3 things. 1. Funds from operations, FFO. Look for steady FFO growth. If it's not growing, it's like trying to sell lemonade in a desert. You're probably doing it wrong. 2. Dividend yield and sustainability. High dividends are great, but if they're unsustainable, it's like eating all the cookies in the jar at once. Sugar rush followed by a crash. One way to gauge this is to look at the payout ratio. The payout ratio is the percentage of REIT's earnings, or FFO, that is distributed to shareholders as dividends. Aim for a payout ratio around 70 to 80%. 3. Debt levels. If a REIT is borrowing like there's no tomorrow, beware. Too much debt is like being stuck in a hamster wheel. You're running fast, but you're not going anywhere. And you're getting tired real quick. And that's it. By keeping all these things in mind, you can make better choices and avoid jumping into a REIT investment blindfolded like a bad game of pin the tail on the donkey. Please like, subscribe, and hit the notifications bell so we can keep bringing you more investment wisdom, minus the jargon. Also, please drop us a comment below to let us know what you like or didn't like about this video, and share your burning topics you want us to cover in future videos. Happy investing, and may your returns be ever in your favor.